Hello there, and welcome to this first portfolio update for my InvestEngine account that I opened back in February. This started off initially as a global multi-ETF portfolio with a small tilt towards the technology sector, with inclusions of iShares, S&P 500 Information Technology ETF, IITU, in addition to a global equity fund. These ETFs overlapped with the big US companies included in both, as I deliberately tried to increase my exposure to US tech stocks, with 75% of my portfolio being allocated to equities and with 25% allocated to bonds, going against my usual mix of 60/40. I wasn't really feeling comfortable with this, so I removed IITU, now holding a 3 ETF portfolio with diverse funds which are more balanced and market crash resistant, which better suits my tolerance for risk as an older and more cautious investor. If you did see that first video that I did at the start of the year, you might remember that I opened 2 accounts. One was a general invest account, as I had maxed out my ISA allowance for the year, and the other was a personal pension, or SIPP. I thought it would be good to compare how the more tax-efficient SIPP would compare against a general investment account, as it's often said that the best way to grow wealth quicker is through a personal pension or SIPP, due to the tax relief benefits that they bring. So I set up these 2 accounts side by side, with identical investments, and paying £100 into each at the same time every month. And let's firstly compare how each account has performed before we look at the individual investments. And already you can see that the SIPP is growing quicker, with it being about £130 higher in value than this general invest account opponent. And this is due to the 20% additional tax relief that is added every time I make a contribution, which, as a basic rate taxpayer, will be an additional £25 for every £100 I contribute. And this additional tax relief is set up to be invested automatically across the investments in the account, which has resulted in those assets being about 60% bigger than those in the general investment account already after a few months, even when taking into account the £21 free share that I got paid into my general invest account when I opened the account with InvestEngine to give that general invest account an early advantage. It's early days, but it can already be seen that it will be growing well quicker by putting money into a SIPP rather than a general invest account. It could be a slightly different scenario, however, if you're paying into a workplace pension. Yes, with a workplace pension, your employer has to pay a minimum of 3% of your qualifying wages in, on top of the 5% that you pay into it, so you would still have a growth advantage when comparing it with a general invest account or stocks and shares ISA. But with workplace schemes, pension contributions are often deducted before tax is calculated, which is where you would then see the tax relief applied. So the 20% tax relief that you get on your remaining net salary is not necessarily added to your workplace pension pot on top of your contributions, unless, of course, you do this manually. So the returns comparisons I made between my general invest account, or an ISA as it would be similar in these circumstances, and my SIPP would probably be bigger than if you were to compare a workplace pension and general invest account. However, with some employers, the arrangement is that your pension contributions are taken after tax, with that relief then being added to your pension pot. So it might be worth checking out these finer details if you are enrolled in a workplace scheme. Okay, then let's move on to the identical investments that I have in each of these accounts, starting with the biggest, which is SPDR MSCI All Country World Index UCITS ETF with a ticker of ACWI. This occupies 60% of my portfolio, and it's my intention that this is the one that gives me my portfolio growth. Being a 100% equity ETF, it is riskier than the bond ETFs that I also have in my portfolio, which I will go through in a minute. But for the additional risk I take on with this one, it does give me a potentially higher return. It tracks the MSCI All Country World Index, which is one of the 2 main all world indexes, which include emerging markets, and the other is the FTSE All World Index. There's very little difference in performance between the two, given they track the same companies in the same countries, but you might see slight differences in regional proportions. And what is classed as emerging markets in one might not be classed as emerging markets in the other. An example of this is South Korea, if you're tracking the FTSE All World Index, which would appear as part of the developed market, whereas it's an emerging market country in MSCI. What is for certain is that whatever index you decide to track, the US will be the largest region by far, giving you exposure to those top US companies such as Apple, Microsoft, and Nvidia. Keeping your investing costs low should be one of your main objectives as an investor, and the OCF, ongoing charge figure, or TER, total expense ratio, which is a fund's administration fee, is a very competitive and low 0.12% for this one. As I've mentioned previously in other videos, the OCF, or the TER, is one of the main charges that investors will face. The other main fee to contend with is what your investment platform or broker charges for you to hold your investments with them. Some might charge a monthly fee, others, percentage based on how many assets you hold with them, and investment platforms or brokers may also charge transaction fees for buying and selling. But with InvestEngine, there are none of those fees, nor are there any foreign exchange currency fees, as all of the ETFs are traded in pound sterling. Getting back to the All World ETF that we were looking at, and it's grown just under 14% in the last year, with the graph showing the regular purchases I've made in the last 6 months. Sometimes cheaper, sometimes more expensive, but always intentionally consistent. Though past performance is not a reliable indicator of what will happen in the future, if I zoom out, you can see the trend line and how much this ETF has grown over a longer period of time. Markets rise and markets fall. But if I just invest regularly, then the average price I will pay over a longer period of time will, if the past is anything to go by, end up being less than the total value of my purchase assets. So I will hopefully see those two lines widen in my portfolio as time goes on, just as it has done in the accounts I hold on other platforms. And I can hopefully show you this as I continue to invest consistently and as I provide new updates. It's fantastic that there are no investment platform fees with InvestEngine, but a downside for me is that you get no interest on any cash that you hold within your account. So any dividends that are paid from distribution ETFs that you might hold in your account will sit there as cash and not earn any interest. So with distribution ETFs, you might want to get proactive and ensure that your cash isn't sitting there for too long and out of the market. Alternatively, choose accumulation versions of ETFs, just like I've done with this portfolio, so that those dividends are reinvested automatically to maximize cash efficiency with you not having to do anything. Given that this is a 100% equity ETF, you can expect higher levels of volatility, and volatility is a measure of the risk that you take. This chart shows its price movement and therefore how risky it is over a period of a year. This is not a problem if you're younger and not having to sell your assets to provide an income in the shorter term. But for those closer to retirement, the volatility here might be too risky, as you might end up having to sell more shares during market lows to achieve what you're trying to achieve from an income. This risk is known as sequence or sequence of returns risk and could deplete your retirement fund, especially if occurring earlier in your retirement. I therefore want to hedge against this by creating a more balanced and less volatile portfolio, which is why the remaining 40% of my portfolio is allocated to bond ETFs. Bond ETFs tend to perform different to equities, with different price movers to help take the edge off large market falls to help balance things out. For instance, when the stock market falls, investors will often turn to safer assets such as bonds, which then pushes those prices up. 60% equities and 40% bonds is a popular choice for investors to achieve less risk for decent returns, and it works for me, but might not work for you. There are crude guides often quoted out there to help you determine what bond allocation you should have, such as matching your age as a percentage allocation of bonds, or subtracting your age from the figure 120 to provide you with a bond allocation percentage. Having a bond ETF allocation of 40% could therefore be a little too risky for me at age 57, but investing is never straightforward, and my total individual circumstances have to be taken into account. They will be different to yours, and your individual circumstances are something for you to consider when you're making your investment choices. I remember that I'm not your financial advisor, and this is a financial education video and should not be construed to be financial advice, and you have to do your own research on what's best for you. I originally had one bond ETF with an allocation of 40%, and that was the Vanguard Global Aggregate Bonds UCITS ETF, the ticker VAGS. This one tracks the Bloomberg Global Aggregate Index, which consists of thousands of government and corporate bonds from across the globe with various durations, with an average effective duration of 6.75 years. With this average, the ETF's value will move 6.7% in the opposite direction to a 1% move in interest rates. This is not as volatile as stocks, but it's still not a complete hedge against market falls if interest rates were to rise quickly or in inflationary conditions. And in 2022, the value of stocks and bonds together both saw falls because of this. In normal market conditions, longer dated bonds tend to provide better returns. This is the reward for taking on more duration risk, where interest rate changes and inflation is far more likely to occur over longer time frames. And in this portfolio, I'm trying to strike a balance between better long-term returns with the longer dated bonds and lower risk through bonds of shorter duration. And to achieve this, 20% is now allocated to the Ishares 0 to 5 year gilt UCITS ETF with a ticker of IGL5, with a low OCF or TER of 0.7%. This ETF, with this lower effective duration of 2.4 years, provides a low-cost way of reducing the overall effective duration in my bond allocation, which reduces it to 4.58 years. This ETF consists of UK gilts or government bonds, so is of the highest credit quality, and I think that this new effective duration works better for me, with still good returns potentially, but for less risk. If you put all three of these funds side by side over a longer time frame, you can see the higher potential growth of the equity ETF alongside the lower growth but better stability bond ones. And I get better risk-adjusted returns by combining bonds with equities rather than just investing in equities alone. So I think that this portfolio now has more balance to it, but that's not the end of it. And as I reach retirement and start having to depend on an income, I intend to increase my allocation of bonds overall by adding an index-linked bond ETF to the equation. This will hopefully act as an additional edge then against inflation. If you look at my portfolio as a whole across both accounts, then you will see there's less concentration in US stocks on the whole, the sectors are more spread, and there's less concentration on any individual company. This provides me with the diversity that I feel I need to ride out any storms, while still finding reasonable returns. Regardless of all these facts and figures I've thrown at you today, the most important thing for you to do if you're just starting is to keep things simple, sensible, and diversified as possible. You can see what I've already achieved this year just by regularly investing. And the sooner you start, the sooner that you get to start building your wealth. There will be downtimes, especially at the beginning. But if you're sensible, don't take on any risks that you can't handle, and invest regularly no matter what the markets do, then hopefully you'll go on to build something special for your future. I'll continue to post portfolio updates over the coming months and years, and we can then hopefully look back positively on my investment journey for you to compare with your own positive journey also. Please comment below what you think of my portfolio, and please let me know what you're doing with yours. Thanks very much for watching.